From an investment perspective, I think we are cautiously optimistic on the environment we're in today. The performance of our assets has been great. Our same store year-over-year NOI growth has been close to 9%, which is fantastic. I think a couple things that are different in the environment we're in today than, call it 2006, 2007 is the amount of equity capital chasing the multifamily space and wanting to invest in U.S. multifamily. We've never seen levels like this before, which is keeping pricing very high. It's keeping pricing competitive, keeping cap rates low. Another big difference is where borrowing costs are today. So in 2007, a 10-year loan fixed rate was 5.75 to 6%. And I sit here today and you can borrow 10-year money at 4.25%. So not only is the interest rate much lower today, the leverage is much lower. We're borrowing at somewhere between 60 and 70%, and a lot of people were borrowing in 2006 and 7 in the 75, 80+% range. I think another thing driving the apartment space is the fact that the stock market today is flat to down in 2018. Our portfolio is, from a cash on cash perspective, is 6 to 8% from operations. That doesn't include sales and refinances within our portfolio. It also doesn't include the value creation activities that have created capital appreciation over the year. At CARROLL, we employ 3 different investment strategies within the multifamily space. I think there's a common theme between all 3 of those. We're really focused on location, supply and demand, fundamentals, job and population growth, employment drivers, and basis, overall kind of what is our cost into the deal, and affordability. And so who's renting, how much do they make, at what point does renting in this apartment after we do some kind of value add strategy not make sense for the current resident base. So we really focus on if we're going to have to turn that base over, or we currently are buying a rent roll that can sustain rent growth over time.